Okay, well, hopefully I don't look too high here in the camera, but it only took me 45 minutes, and I browsed through the Q3 December 2018 Anfield MD&A, which wasn't too long. Um, I didn't get very much financial truth in it, but I got kind of some ideas. The background got me close to maybe finding some net present value on this thing. I'm not sure, but I guess to start, it talks about the Shootering Mill, which it's one of three conventional permitted constructed mines in the U.S. and licensed. It's funny, it was built in 1980 and it processed 30,000 pounds in ore, and then it closed in the early 80s after the price dropped so much. So I thought that was sort of shocking. There might be a cost to bring that back online. But then when I look at Uranium Energy, White Mesa Mill, which is pretty similar, it was built in 1979 actually. Um, and they just got new permits in 2018, but they processed 1 million pounds in basically a year from 2011 to 2015. Um, so I thought that was interesting. The next question then is how much would it cost to get that thing rolling again? And so that you go back to the end, just how much is it worth in general? So apparently, Uranium One bought the mill for $50 million in 2007. Um, that's pretty near the frothy state. It was starting to be, we thought it was going to last forever. Other companies were coming around, probably competition. So that's probably a frothy price, 50 million, 2007. So then they turned around in 2013. Uranium One divested a lot of assets. ANLDF got most of them from them. So $10 million. Uranium One sold to Black Range Minerals, which was kind of a struggling on and off, delisted, non-delisted uh, company, and they did some weird things. So eventually, Western Uranium bought them with the other mill licensed but not produced of Pinion Ridge Mill in Colorado, which has recently been going through some licensing issues. So they must have been a holding company for a lot of mills or something like that. But turns out they must have had a liquidity crunch, so they sold to Anfield August 2014. Like, what a great time to buy an asset in the uranium space for $5 million and some mining properties. So the mining properties, I believe, would be the Velvet Woods, or maybe that was purchased in another transaction. But in the end, they bought it for $5 million. Right now, their market cap's $7.5 million. So I get that they're losing money, but the asset value there is, I don't know. I mean, in 2013, it was 10 million. Um, you know, it's supposedly $35 million to put back into use, so that's something to consider. But you're basically buying, I mean, a $50 million asset in a, you know, possibly normalized price, maybe 25 million, we'll say, is the intrinsic value of this guy at $60 uranium price. Um, so there we go. $25 million we're going to assess to that portion. Next, they have the Velvet Woods uranium property, which was in production from 1979 to 84. So I think that period was a pretty big production period. 4 million pounds over the course of that. So it's basically 1 million pounds a year. And they also include vanadium. So that's really interesting. But when we're looking at $65 a pound uranium, the net present value on the Velvet Woods project is $55 million. So put those two things together, I'd say $80 million company. They should be about 10x what they currently are. Then you'll wind down into the share structure. So this is where it gets really interesting. Current shares are only 44 million, but we have 4 million in options with strike prices of 55 cents up to $5 over the course of 5 years. And right now it's sitting at 17 cents. So not only are some things going to roll off unstruck, I guess, or redeemed, um, they go up to $5 into 2023. Um, so interesting. And then the warrants, they have a lot of warrants, $24 million in warrants, but they have pretty high prices. So they're going to be getting a lot of cash here over time. It seems like they have it like separated it out enough that we could see a lot of upside. You know, even if it goes up to the warrant price of 40 cents, what do we got? One and a halfer? But from 40 cents to $4 is where it goes. So, really interesting share structure. I'm not 100% sure how to value that, but another thing that I thought, and this is the last bit here, and then I'm done rambling for 6 minutes about ANLDF, but I would need to look into their people more, but I really like the process they've gone through so far of building up some assets. They had a few other random assets, but I don't know. I wouldn't put too much into them. But the other thing that I thought super interesting here is that they are also a royalty company. So at some point along the line, they bought some streams in these companies. Azarga, the Dewey Burdock, which is the highest grade unproduced undeveloped uranium project in the U.S. They have a 2 to 4% sliding scale royalty. So if they produce over a certain amount, they'll get 4%, under 2%. They have a 2% net smelter on WSTRF San Rafael complex, which I don't think that's a Sunday Mine complex. They have 2 to 4% on the Uranium Fuels Whirlwind project and 1% on Uranium Fuels Energy Queen project. So, really interesting company. I cannot imagine that the intrinsic value is where it is. They definitely will need to raise some cash, I would guess, so you could raise up the structure. But I can't see it lasting much longer, and looks like a very interesting company currently.